The Exit Series is produced for general information and educational purposes only and is not investment, legal, or tax advice. Views expressed are those of the host and the guest and do not necessarily reflect those of any affiliated firm. The host is associated with an SEC-registered investment advisor. Nothing herein constitutes an offer or solicitation of advisory services. Guests are not necessarily clients. This is the Exit Series. I'm Bob Rourke. This is for founders, brokers, and attorneys, the people who are in the room when the deal closed, talking about what happens next. This is the conversation nobody else is having. For the first episode of the Exit Series, my guest today is Sean Hutchinson. He and I have been breaking bread over this conversation for years, particularly cinnamon rolls. He's founded 5 companies, all of them with partners, some more successful than others, and led a fast-growing global company which became the largest firm of its kind in the world. He's third generation, a 67-year-old family business, and a board member. He's been in the room when the wire hits, and he knows what happens after the deal team moves on. The business readiness gets handled, the financial readiness gets handled, the part where the founder figures out who they are without the company, that gets skipped. Sean spent 25 years working that gap. If you're a founder approaching an exit or an advisor sending one into it, this is a conversation that nobody's having early enough. Sean, thanks for taking time and being on the show again.
Yeah, good to see you.
You bet. So here we go. Sean, you and I have been having this conversation literally over breakfast for years. What's the exit planning industry getting wrong?
You know, a few things stand out after, 20 years doing this work, probably longer than that. First, I think now, finally, in a certain way, the baby boomer tidal wave, the silver tsunami that folks have been talking about for a long time, I think it's kind of finally cresting. It's taken a while. This was supposed to start about 2008, and here we are in 2025, still kind of waiting for it to start, honestly. And we'll talk a little bit more about that, in the future, later in the interview. But I think that the industry, our profession, and the profession that everybody that you mentioned, the lawyers and the accountants who are working with business owners, I don't think we're necessarily scaled up for it. That's point number one. I don't know that we're really, really well prepared for it. Second, I don't think there's enough talk about risk in the conversation with business owners. And I think there's too much, maybe, emphasis on the business and the value of the business. You talked about 3 legs of the stool and that importance of personal readiness, the sort of life after business picture. I personally think that the conversation is starting with business and moving from there. And I think it ought to start from the other end. It should be personal readiness and then move back towards the business with all the stuff that's in between. So I think we kind of have the sequence moving in the wrong direction, and it would benefit from prioritizing the conversation about personal readiness with the owner. The business plays a part, right? It's 80 to 90% of most business owners' net worth. So there's a huge amount at stake. They're crazy concentrated in one completely illiquid stock, which is just a awful investment strategy. We have to manage the downside in so many ways, and a lot of the conversation is about the upside, the growth, the profit, optimistically, all those good things that can happen out there. And I just don't think risk is enough of the conversation. Third, I think the industry still treats exit as the primary motivation for owners, when a lot of owners, especially family business owners, treat legacy and relationships and identity really more importantly than the exit of their business, right? So, and keep in mind, the majority of privately held businesses in the United States are family owned. So this is a big segment of the marketplace. I think we're in some ways having the wrong conversation with them, and we're kind of, flying by each other. And then finally, I think exit's probably the wrong word in many cases to use in these situations. It implies kind of a finish line. And I don't think that's what we're talking about. I think we're talking about a life transition at that point where they might transition ownership in their business. And I think that framing, the change in the framing from exit to a life transition, really matters. I think it opens up the conversation. Now, for all of that, it's worth adding that, our ability to interact with business owners is actually improving. So the most recent version of the Exit Planning Institute survey the state of owner readiness for transition showed that business owners that are seeking outside advice has increased from 38% in 2013 to 68% in
Wow.
2023. But the majority of those were in the younger generations. Baby boomer business owners still resist outside advice. That has always been an issue. So the baby boomer business owners pretty much think they've got it nailed, and they don't, because we're not actually talking about three dimensions of preparing for transition. In many cases, they're just focused really on the business and to some extent on the financial planning. It's also worth mentioning there that 78%, I think, of the people who were surveyed said they preferred to transition their businesses internally rather than sell them to a third party. So that's a big thing. And ESOPs have seen a 400% uptick over the past few years. So there's a huge interest in employee ownership.
Why do you think that is?
Structural moves in the marketplace recently that I think are important to acknowledge.
Now, is it just knowledge and people getting out there talking about it? What do you think the ESOP move is?
I think that's part of it. I think you have a lot more advisors who maybe are certified exit planning advisors, for instance. There's 9,000 or 10,000 of them out there. A lot of people have been talking about exit planning. I think, honestly, it's almost become faddish to talk about exit planning. And I think there needs to be kind of a new vocabulary around it one way or another. But all that said, I do think there is a richer, deeper conversation going on at the national level around this than there was 10 years ago, no doubt. And I think it's accelerated over the last 5. But interestingly enough, I think the majority of that conversation is with Gen X and millennial business owners, not necessarily the baby boomers, even though the baby boomers are going to be first out. Father time always wins. So,
I saw a term the other day. It said transaction to transition. And I really think that's a reasonable, way to phrase what they're doing. And, my sense of things is that the owner that transacts and exits doesn't have a good idea of what's coming. I just don't think, at least it's been my experience.
I think that's true. And it's interesting. I feel like they should, honestly, because in the business owner community, typically the people that they spend a lot of time with are other business owners in the same generation. So, and baby boomers have accumulated some wealth. They often, join the country club or whatever it may be. They have other business owners that are inside of their circle of influence. And a lot of those business owners at one point or another exit. So they ought to have a community people who are talking about it and sharing their experiences. But I think also it's such a hard thing to prepare for and go through that when owners share their experience, it's not always a positive representation. So what owners who have not been through it here is that doesn't sound like very much fun. I think I'll just put that off, right? I know it's coming, but I think I'll put that off as long as I can, because that did not sound like a fun experience at all. And we'll talk about it, even though a lot of those, transitioning business owners may have walked away with a number with real wealth in their pocket as a result of that. The sort of narrative that surrounds that transactional piece is very different than just, I got a check and I'm happy with it. There's so much more to it. And I think our discussion today is going to reveal a lot of that.
In thinking about that, so you're third generation with your family business, and 67 years, I didn't even know that number on the manufacturing side. So for you, a lot of folks think, well, where did you learn a lot of this? Well, you've lived a lot of it, so it's not textbook for you. And when you sit across another family business owner, what do you typically hear that an outside advisor just plainly misses in that conversation?
Well, I don't know that the outside advisor always misses it. They may, in fact, see things that are really valuable, but they may not know what to do about it when they do. Right. So the conversation, then it kind of hits a wall. It's kind of like, well, we'll just push that aside because, I call it that, that it's almost like the business itself when, for instance, a financial advisor is in a meeting with the business owner and they know that the business is going to be so crucial in the financial planning and the long-term life, right? That owner and their family is going to live after whatever happens. But they kind of don't know what to do with that kind of asset. So they put it in the corner of the room and they pull the potted plant in front of it. They know it's over there, but they just are not really seeing it. They're missing things because they don't know exactly how to deal with it. So that's always been a bit of a challenge, is getting everybody to spin up, if you will, around this unusual private business. These are not easy things to deal with. They don't just monetize. They're really, really hard. So I think that there may be a struggle around, if I see it, what do I do with it? And if I don't know what to do with it, then maybe I'm just going to kind of let it lie, right? But there's another thing about family businesses. And I think if you're going to really think about family business, you got to lean into the complexity that's inherent in these things. So family businesses throw off sparks unlike any other kind of enterprise. Honestly, it's a multi-generational partnership where only a few people own something and all dozens can have a stake in it, right? Mm-hmm. They've got something to say about the business, even though they don't own it. And they may have a stake in it emotionally, financially, personally, right? Maybe a part of the legacy, the way that they see themselves. That dynamic can be quite invisible to advisors who never really worked in the family business area. I also think what we call knowledge atrophy is a massive and underappreciated risk in family businesses. Each generation carries things in their head that have enormous value, but they never get written down. So those could be customer relationships, institutional memory, the way that decisions actually get made, the decision trees. A lot of owners just know that stuff. They can go through a decision tree like that, like this way, that way, and they just do it. But other people in the company don't have that capability because they just don't, it's not their orientation necessarily. They haven't been around that long. By the way, I think our family business is 70 years old now. I think it was founded in, so now we moved into a new decade, I guess. So, when that first generation exits the business, let's say that they move on in one way or another, that knowledge that's so valuable, which is a big piece of the goodwill in a business, is knowledge. It's the human capital, drives a lot of value. It can walk right out the door with them, right? So knowledge management is a big deal. And I think it's particularly important in family businesses because it's the way that they see themselves as a family through the generations. I think change is also just kind of top of mind for a lot of older business owners. They're just kind of at that point in their life where they know things are going to change, right? They may be backing off to sort of drawing back from some of their business management responsibilities. They're seeing kids, maybe multiple generations, come online and perhaps get involved in the business. So they're thinking change. They're dealing with it all the time. It's a big threshold coming up, but it doesn't really work its way into the business strategy or operations, right? They don't think about what the effect on the business would be. And it creates this weird little emotional brew, I think. So it's a combination of confidence and anxiety. It's what I would call doubtful optimism about the business and the family and its future. They absolutely believe in the business. There's no question, right? If you ask them about the health of the business, they are proud of it and they want to talk about it. And there's a lot to talk about that's good. They're just not sure that they'll get the transition right. So they believe in the business, but they're not sure about the transition. But this thing is 80 to 90% of their net worth. So they don't have an option. This transition better be right. I think the last thing I would say about it is next generation voices are often absent, silent, or in the worst case situation, silenced at the time where these conversations matter the most. And that's a structural failure, by the way, and it compounds over time. The more it happens, the worse the situation gets as it moves on.
My sense of things, and we've talked about this in podcasts before, is being able to transfer the owner IP is challenging. And I think for some of the folks that are working with those owners, if they've not been a business owner before, and it's just a different vocabulary and it's a different experience to be a business owner, and and what to do. But when we think about segue into another thought, what does not ready actually look like? When someone's sitting in front of you and the deal machine's going and deal fatigue's going and all the records and blood samples and everything else is going on, what do you? It's just like everything. What are you seeing through that fog? What sticks out in your mind when you're in that process?
Well, look, I mean, fog is a good word for it. The fog of war, in a way, right? We could call it the fog of due diligence. So deal due diligence is unlike anything that owners have ever experienced. Honestly, it's their life's work, their families' work in some cases gets picked apart by people they've never met and probably won't, and don't particularly care how hard it was to build this thing, right? Their job is to come in and find the things that might get in the way of the buyer's success, not necessarily find the things that have enabled the seller's success. It can feel really offensive to business owners, deeply offensive to them, to go from successful entrepreneur to a financial risk on paper as part of a due diligence report, because that's what's happening. This whole thing, decades perhaps, is going to be boiled down into a report that the due diligence representatives hand to the investment committee or to the buyer, and they say, this is what we found. And most of it, most likely, is going to be, without preparation, is going to be negative, and it's going to drive the value down, and it's going to drive negative terms. So it moves really, really fast. That I can't describe to a business owner who's hasn't been through it just exactly how many questions are coming through at any given time. Document requests, hundreds of questions hitting in a very short period of time. And they're still trying to run their business, by the way. So deal fatigue is really weird, is real. It's emotionally exhausting. It's physically exhausting. So, the line I hear the most often actually is kind of after the fact. Sometimes it's during the due diligence process. And it basically is, I wish I had listened to you. I wish that we had gotten more ready for this. You tried to tell me what it was going to take, and I couldn't get it. And I have said for years, we do the best we can to prepare people for the experience, but it's really, really difficult. I've said sometimes that I wish I could film the due diligence process for a client that's going through it and then share that with other business owners so that they could just kind of see the way that it works. But I think it would probably be too profane to share with other people.
It's kind of like jumping out of an airplane. You could describe it, but there's nothing like standing in the door, for sure.
It's very true. Yeah. Yeah.
In that process, there's a gap between what the business is worth and what the owner needs for their life post sale. How often is there a gap? And what happens when somebody finds out at the closing table that there's that gap and not in the 2 to 3 year pre-planning process time frame?
Yeah. Well, I mean, we don't really have any research on how often there is a wealth gap, right? So I can speak anecdotally for myself, and it's really, it can be different by generation, honestly. Younger generations always have a wealth gap, right? Older generations, they may have saved outside of the business and made good investments, but the business value really usually scales faster if it's going well than outside investments that may grow really quickly, but also, it's just not as big a number, right? Mm-hmm. There aren't as many assets in terms of value there. So to go back to finding out at the closing table, honestly, I think it's a disaster. It can be a tragedy, and it's exactly what a good value acceleration and planning process is designed to prevent. If we do our jobs right, finding out in the closing table that you have a wealth gap just shouldn't be an issue, right? Because you've got the right team. So in my experience, there's a wealth gap, a material difference, I guess, between what the business will yield and what the owner or their family actually needs. Maybe 60 or 70% of the time. I mean, that's pretty high, but we also find that not enough owners have done complex financial planning or even basic financial planning. So we can't really know if the wealth gap exists, right? And therefore know if there's a value gap that we have to cover with the business if the owner doesn't have a financial advisor and doesn't have an updated financial plan. It tends to be less prevalent, as I said, in older owners who've saved and invested well over time. They may have a plan. Whether it's updated, whether it's good is another question, but at least they've grappled with and answered some of those questions. But without a plan, you're absolutely guessing. And the mantra of planning should be no guessing, right? How much data? You can't argue against data. So do everything you can to get data that helps the client and helps you do a good job. Let's talk about the math for a minute if people aren't familiar with it, right? So there's some danger in this math. You'll know this well. You're on the financial advisory side. So let's say that an owner sells for 20 million and we use the rule of 4 withdrawal rate on that 20 million annually. You're going to have 800,000 a year to work with, but capital gains taxes are going to take a bite out of that 20 million. So maybe you're down to 16, depending on whatever your basis is in the business, which by the way is almost never well tracked in private businesses. So, now you're drawing down on the 4%, 640,000 a year. How's that going to be taxed as it comes out of that, out of that pool? Does it replace the income that you were earning from the business before you exited? Maybe it does, maybe it doesn't. What about rising healthcare costs, right? Lifestyles that you want to live, second homes that you want to buy, so to speak. I was in a situation the other day, and I don't know that it's all that unusual. The owner needs $100,000 a month to live like they live today. Their business throws off a lot of cash, right? Now they could sell their business for a lot of money and they could probably cover that. But if you took 16 million at a 4% withdrawal rate and you need 100,000 a month, the real number that you need after tax is 30 million to cover that. Now, 16 million to a lot of people sounds like a lot of money, and it is. It's adult money. But in those cases, it may not be near enough, and you don't want to find out that you're 50% short of the number at closing. That can't happen. So what's the lesson? Get a financial plan right now, if you don't have one, completed by a qualified professional, maybe a CFP, maybe not a CFP, but somebody who knows what they're doing. Share it with your entire advisory team. Share it with your attorney. Share it with your accountant. Make sure that they have the data that they need to really round out this holistic picture. Everybody on that team needs to understand what the number is and needs to understand the stakes if it doesn't materialize.
You're in the steep and deep in the business of preparing the owner. I mean, this is your world, right? And so you've got the owner prepared. Then you've got the broker that markets the business and the attorney that closes the deal and the wealth manager that takes the money. And somewhere in that whole process, you've got the business owner that's deer in the headlights after deal fatigue and and he's waking up the next day and maybe the phone's not ringing and they're going, I'm the former owner of whatever. They fall through the cracks. Do you think that happens frequently?
I do. I think I don't know that it happens every time, but I do think it happens frequently. And I think it's a failure of process. And I think it's a failure of the professional team to cover the full ground necessary to make this work for the owner. Okay. I think to a certain extent, it's on us to make sure that this happens. Now, the owner may be resistant to some of this stuff. I've had plenty of owners say to me, we'll work out the financial plan once I sell the business, right? I'll talk about life after business and my personal plan, my personal readiness. Just get me the money and then we'll figure that out. Absolutely terrible way to do it. And that's why I say that the team, right, needs to be brought together early. And I think we should start with that personal planning because it should be a North Star that guides all of the other things that we're doing. So what's going on? So when that happens, when the owner falls through the crack, the first problem really is timing. And what I mean by that is the team that's going to help them with that needs to be assembled early, not as each of these distinct roles starts to be relevant to the process, right? So, sometimes on the transactional side, you don't need a broker, you don't need an investment banker until the owner makes a decision about, hey, I think I want to run a process and sell my company to an outside buyer. But you need somebody on call who can also sort of begin to get involved in the conversation so that they don't take just a solely transactional view of what's happening. So it really needs to be collaborative, I think, from day one, with everyone looking through the same lens at the same owner, the same goals, and the same emotional picture that we're dealing with. The second problem is that we're losing the owner at the center of the process, right? So, we need to have a conversation with them about that. We need to be constantly asking them and ourselves, how is the owner experiencing the process? What's their emotional state? How do they process change? Because there's going to be an enormous amount of it. I honestly, I have watched owners have genuine nervous breakdowns in the middle of this process. That's how emotional it gets. That's how much stress there is. And we're asking these folks to make some of the biggest decisions of their life under extremely stressful, compressed circumstances. And I don't think very many people can do that. You and I had an interesting conversation about this. When I asked you, how does the military, you were in the military, how does the military train young people who have never really been in a super stressful, potentially deadly theater? How does the military make that work when these folks are 17, 18, 19 years old, right? And some of the things that you told me were, we have structures, right? We have structured debriefs. We learn from one another. We have buddy systems. We have graduated exposure. We don't just throw them out there until they're really ready. There's explicit emotional preparation before the hardest moments hit, right? You said there was kind of a process to that, but we don't have anything like that when we're dealing in high stress business transitions. We don't have anything like that. We send people, honestly, into one of the most identity disrupting experiences of their lives, backed by a legal team and basically looking for a wire transfer. That's the definition of success if we're not careful. So in addition to that, language matters. Words matter. The way that we talk matters. So we're technicians. Techno speak is right in our wheelhouse. We're very comfortable with that. For most owners, it's gibberish, right? Techno speak alienates people from one another. It doesn't connect people. And it alienates us at exactly the moment when an owner needs to feel understood the most, right? So one of the things that we use around here is just a simple phrase: connect before content, always.
Yeah, I think, what is it? The stats are on the owner regret of sale within the first year. I think it's 75, 76, it's somewhere in that 75% arena.
Yeah.
And, you see it from your side. Do you really think that's a true number? Do you think it's about the deal? Or do you think it's because the guys and gals never had an idea of what was coming on the other side of the wire?
I think the number is real. I think the science behind the surveys where these numbers keep cropping up is pretty sound, honestly, and it's been consistent across many years. It's not just a spot check. So EPI, Exit Planning Institute's been tracking this really pretty regularly since 2013. PricewaterhouseCoopers does a significant survey of business owners around this issue. And that number, 70 to 75%, just keeps cropping up, right? I don't think the regret. is about the deal. I don't think it's about the money. I don't think it's about the structure, although there can be a lot of frustration on the part of the business owner. This to a certain extent a myth that they're just going to get a check at closing and not have to, continue to work in the business for a while, or maybe accept an earn out, which none of us ever recommend if we're on the owner side of the table. That kind of risk shifting from the buyer back to the seller happens all the time. So, that's where good preparation and good education can help sort of set realistic expectations around what it's gonna be at the end of the day. But I think it's not the deal. It's on the other side of it, right?
Yeah.
It's what happens after the transaction is complete. That same kind of research that shows that 75% regret also showed that about 60% of owners who reported regret had no formal personal plan for what came after. So there is definitely a link between the two. There is a correlation. You have to imagine these people spend months, maybe years, preparing the business for sale and zero time preparing themselves, right? All of that attention has been on the business, very little on themselves. I would argue for a lot of entrepreneurs who are working really hard, have been head down, right, for a long time. I don't think that's unusual. We believe that I'm a business owner. I believe that working on my business all the time. Do I stop and say, how's it like? Am I taking care of myself? Am I really, thinking about all the issues? Probably not enough, honestly. So you're right to point out the shift from being a business owner and usually a community leader. There's some presence and visibility there, to going to nobody calling anymore is deeply shocking, honestly, without a plan. I mean, it can be really, so at the end of the day, I don't know that the regret is about selling necessarily. I think it's about, people can find real meaning and purpose after they exit. Those that find it quickly are usually doing a little bit better, and most can find it if they're given enough time, right, to really do it. But if you can't do it pretty rapidly after the transaction, if you're not ready to sort of move into a new way of living, then we've seen people end up in really hard places. So divorce, substance abuse, really destructive behaviors, and recovery from those things is really difficult, right? So the prep is the key. I don't think it's just financial literacy. It's really emotional literacy as well. But you need financial capacity and literacy, and emotional capacity and literacy. And I think the team can help them explicitly develop these things before the wire hits. That moment when the wire hits, by the way, there's going to be, another factor that hasn't been present before, and that's a lot of money. And that changes people.
Yeah. There's that old joke, and I married you for better or worse, but not for lunch.
Yeah.
And you go like, there's that dynamic, and you've been there after the close, when the owner, the noise settles down. I was at a conference here not long ago in Denver, and they had a panel up there of business owners that had sold. And so what was the next day like? And he said, no parade, no basket, nothing. He said, I went right back to work. It's like getting pulled through a knothole, and I'm back at it. Or in, some of the owners, it's just like leaning into the wind and the wind quits blowing, and in your experience, and maybe a story without revealing anybody's name, what's like the most profound, poorly executed next day that you have in your memory bank is like, I'll never do it that way?
Well, all of our clients have been wildly successful, so I don't have a negative story that I can tell. What I can say though is that, and that was kind of a joke, by the way. But
well, I was thinking, but I know you, and I know what you guys do, and there's a reason the discussion is had. That's why.
Yeah. Well, I think there is there is an after effect, right? There's something, you bring up a good point. Let me put it this way. So after the transaction, right, there is a lot of money in the bank account, right? Potentially. So they're literally holding digital bags of money, possibly in amounts that they never imagined before. But ironically, their world has gotten smaller at the same time that their bank account has gotten bigger, right? And that there's a weird cognitive dissonance to that. Without preparation, I'm saying it doesn't happen to everybody. And that advisory team that's been orbiting them, right, for months, maybe even years, that they've been working with, they just kind of go silent overnight. I mean, every once in a while, you may get a phone call from somebody that says, "Hey, I just want to check in and see how you're doing." But for the most part, their team is done. And there's no real protocol for that kind of transition, right? There's no offboarding. There's no check-in at 90 days. It's done. The support system of a sort just disappears. And I think the owner actually can have advisor withdrawal syndrome, right? It's kind of like, oh, these people really helped me out and they became my friend and now they're gone. And I think family and friends can step in where they can, but as you said earlier, I don't think anyone really understands the weight of what just happened for the business owner. It's quite lonely in a way, and it's hard to explain to somebody who hasn't been there. And that can lead to a kind of isolation that can lead to a bad story. And I have a colleague who went through something. It was a farm family. It was an agricultural family where there were, I think, 3 siblings, maybe 4. And one of them had worked, it was son, middle son, I think, and he had worked on the farm his entire life. So, but the other 3 had gone off to other careers and they didn't live on the farm or anything. So dad dies and he's really been the scion, right, of the farm. And the other 3 kids show up and they decide that the best way for them to get something out of the farm is to sell it. So here you have, and he's outvoted, right? It's like 3-1, and they're going to sell the land and sell the farming operation. And, everybody's going to walk off with some cash and fairly substantial amount, including that middle son who's worked there his entire life. But he didn't have anything beyond that, right? So he's lost the relationship with his father, who he worked with daily. He's lost his sense of purpose because the job's gone, right? He ended up moving to another city. He ended up divorcing, cutting ties with the family, and he became an alcoholic.
Yeah.
Right. So it can happen. That might be extreme, but I think it's a risk that it could happen in a lot of cases, but it doesn't have to happen. This is entirely preventable, entirely, with good planning.
You mentioned the 3 legs of the stool earlier, the readiness, which you're steeped in deep in, the personal readiness, which you address and talk to folks, the financial readiness, where you recommend, and there's a percentage that do, and there's a percentage that doesn't. We kind of have an idea which one gets skipped in that crowd. If you would, if you could talk to the founder that's listening right now and who thinks they're ready because they cleaned up their EBITDA and hired an attorney, what are they missing? What's the chief thing that they think they got handled, but they don't?
Well, you're right. I mean, we've been signaling it throughout the conversation that the leg of the stool that gets missed is that personal leg, which is why I'm advocating for starting with it to make sure that it doesn't get shoved over to the side. And we've been I've been harping on this for a decade, and I can't tell if it's improving. And I probably, I wouldn't be talking about it if it was. I do think there is some evidence that it's getting better. In terms of readiness, business readiness is concrete, right? You can put it on a spreadsheet in a sense. You can see it. it's tangible. Financial readiness, once you have a plan, it's at least measurable, right? So we have data points, but personal readiness asks the owner to sit with a level of uncertainty about who they are without the business in their life. And that's a pretty uncomfortable conversation. And most advisors aren't trained for it. So it gets avoided, right? I mean, living in that sort of inside the mind, so to speak, is not, that's complex. And what a founder is missing in those cases is the planning complexity that comes with a truly holistic process. And I know that doesn't sound very appealing to embrace complexity in that way, but when you lean into that complexity, it's actually an opportunity to shape what your life looks like on the other side in meaningful ways, right? So if you don't lean into the complexity, you never really get to the point where you can address these profoundly important issues that allow you to pursue a trajectory that makes sense for you and your family and allows you to live out a purposeful, meaningful life. Instead of going around the complexity, you actually have to go, the only way is through, right? So you have to get a complete team, first of all, that can cover this. You got to make sure that they understand all three legs, that they can work together. I personally believe that a SEPA credentialed team is going to be really helpful if you can get it, because they're people who have been trained in the three legs of the stool. They understand holistic planning. They can look at the whole picture and collaborate, not just on their piece of it.
We're talking about, the interaction with the transaction folks, and I have this image of, was it one of the Charlie Brown characters that had all the stuff swirling around him all the time?
Oh, yeah. Pigpen.
Yeah, a lot of things going on. And so they finally check the box and the advisors move on. In your mind, there's probably a business owner event when it clicked and they went, oh, I get all the pieces now, right? I understand. Walk me through what you think that looks like or what you saw when that owner got there.
Well, what you see is something, you see them transformed, honestly. And I think a good planning process ought to be transformational. Not many people really love change. And as I mentioned, there's a lot of change in this process, right? And in general, genuine transformation, I think, requires the conversation to get really personal, deeply personal, right? So what I see when it works is a kind of gratitude. And it's not necessarily for the advice. That's not it exactly. It's because the owner appreciates being seen, honestly, in this whole process, for having someone ask the questions that don't appear on the checklist. Right. And transactional conversations are easily forgotten. Transformational conversations stay with people. There's behavioral science behind it, right? People remember how something made them feel far longer than they remember what was actually said. That's the difference between a transactional checklist conversation and a transformational process. One, the first, transactional, is completely forgettable. And the other one changes life's trajectory in some really interesting ways. So, I'll bet you, if you talk to a business owner who had sold their business, for instance, gone through a transaction process of any kind, 10 years later, how did that work? Like, what were the mechanics of it? They probably couldn't tell you anything about it. They will have forgotten it entirely. And the transactional advisors, honestly, they probably couldn't even come up with their name. Mm-hmm. But where the transformational things were happening, they're going to remember that forever. And I think those conversations are going to be the ones where the owner will say to another owner, you're going to have to go through this. I was lucky enough to have a good team and do the planning. So let me tell you what that felt like. It wasn't all pluses, but there were not as many minuses. And it actually turned out to be life-changing for me, which is what it's going to be one way or another. It's going to be life-changing.
Yeah, I'd say, we've talked about, all of kind of the challenges and indoor problems, and there are success stories out there where the owner did the work, and they're past it and them and they're they're thriving. What comes to your mind when you think about one of those individual owners that really executed well and are thriving? What would you say comes to mind?
Well, I'll kind of take you through what I think is a consistent formula for this, the things that show up often when you see that thriving afterwards. And I'll tell you a story. So I think the formula is pretty consistent and when it works, right? So there's a good advisory team. There's a good leadership team in the business that they can lean on. They've done their holistic planning across all three legs. They started early. They didn't try to rush it in at the very end. And they prepared explicitly for that emotional reality of that life transformation that's going to happen. And they had a personal support system in place before the transaction closed, right? So I don't think everyone really skips every piece of that. I think there are always things that are fine, but skipping some of those seems to be kind of the norm, right? You get every case you look at, you're like, well, it wasn't perfect, but it was pretty good, or it was a disaster, and it's because all this stuff was missing. So I think the owners who genuinely thrive after exit are probably the most personally ready, and they know they're personally ready. So it's not that just they are personally ready, they know it. They have confidence in it, right? And it's that confidence, not in the deal, but in themselves, is what carries them through that period. So we had a client, longtime client, probably worked with him for 10 years. He had a lot of businesses, so we worked with him for a long time because it was a pretty complex situation, and structurally and otherwise. So, he was very intentional about reducing the dependency of the businesses on him. He recruited and empowered a great leadership team. He gave them room to run. He trusted them, right? He still remained involved. He wanted to help guide them. He was unlike a lot of owners who struggle in the area of managing a leadership team, he was a phenomenal communicator. And he was able to strike that balance of, yes, I'm the owner, and so some things I'm the final decision maker, but he was always able to not come down hard on the leadership team and allow them to develop and take ownership for what they were doing. And he really challenged them to change the direct trajectory of the companies, right? And rewarded them for doing so. He was kind of late with his financial planning. I bugged him for years to get started on it and to find a good team. He finally, as he got closer to the time that it became clear that these two businesses, he exited them simultaneously, literally like back-to-back closings. He finally realized he was going to have to get on it, right? And we were able to get him a good complex planning team, bring him in on short notice and really get him started on this. So because it was short notice, unfortunately, they weren't able to do everything that they normally would have done, but they've been able to do a lot. So his personal planning has gone from incomplete to good, and he has a multi-generational perspective. So the conversation started really around, how do I get this wealth from my generation, owner generation, to the next generation? So he has 4 kids, and he was really working on that. And of course, he's married, so he was working on how to manage the risk for he and his wife. So, but it shifted as he went through planning to a multi-generational perspective that was rooted in their family values, very strong family values. And they wanted money to be treated as a family advantage, but also charitable. They didn't want any of the kids or grandkids or even beyond that. I mean, he's planning 4 generations out. So he didn't want anybody to be ruined by wealth. And, this is not giant, but it's $200 million. Mm-hmm. So that's real money for sure. And it's going to grow across generations if it goes well. So he's been able to kind of see 3 legs of the stool in action. Wasn't perfect because, quite frankly, there were things that he resisted, personal financial planning being one of them. He was pretty good at imagining that life after he exited the business, and he started to get a sense of, hey, I've been working, 80 hours a week for 25 years. What's going to happen to me? But he did a good job as he moved through the process of sort of letting himself warm up to that, not just making quick decisions. Very thoughtful guy. And the process probably saved him, by the way, $25 million in taxes. I don't know what he's invested in, estate planning and tax planning, but it wasn't 25 million. So he's gotten a decent return on that. But it's taken 2 years. But here's the aspect, I think, of someone who's thriving on the other side is that not only have they had a plan, but when they look back on all of that stuff that's happened, they're 100% at peace with how it went and where they've ended up. They knew there were a lot of paths that they could walk here, right? They had a lot of choices. There are a lot of ways that they could go. But wherever they ended up, when they look back on it, they think everybody's going to be okay. I'm going to be okay. The business is going to be okay. The people who still work in the business are going to be okay. In fact, they may be better off than I ever could have gotten it to for them because now they're with a bigger company or whatever it may be. But they know that they did the work and they're at peace with it. And that's what we want to see on the back end of this process.
That segues nicely into this question, and this is your playground. If you could grab a founder a couple of years, 2-3 years before they exited, not to necessarily improve the deal, which is truly where you excel and focus, but to prepare them for life after, what's the one thing you would tell them to start doing now?
I'd start with a framing question, what we call a framing question, which always starts with what would it look like if? That's the way that a framing question starts. And I'd ask them, and I'd ask them to kind of sit with it, not to answer right away, right? But so the question that I would ask them 2 or 3 years in advance is, what would it look like if you felt a profound sense of self-worth and meaning completely apart from the business? Take the business out of the picture. What would that look like for you? And I think that question honestly tends to lead one of two places, either to clarity about what that future needs to look like, or reveals a vacuum of some sort, right? And both are actually useful. If there's clarity, the clarity gives you a destination, right? It may not have every piece, every step right along the way, but at least gives you a flag in the ground that's pretty well defined. If there's a vacuum, it's an early warning system, right? Gives you fair warning that there's still work to do before the wire is going to hit your bank account. So
how many do you think are clear? How many do you think are clear versus not?
Yeah, it takes a lot of, well, that's why I want them to sit with it, honestly, because I think a lot of people, when you ask a question that way, they're kind of like, okay, well, I don't really know the answer to that.
Yeah.
And the point is not to know the answer, but to grapple with the core question, which is, we take the business away, what gives purpose and meaning, right? What is that profound sense of self-worth and meaning? We often talk about purpose and meaning, right? But I think that self-worth is a really important part of the conversation because a lot of owners find self-worth in their position as a business owner, in earning a lot of money, potentially, in being proud of what they've created. All good. I agree. But if it's all tied up in the business, if that whole self-worth is tied up in the business, that doesn't transfer, by the way. It's not like, oh, I'll just pick it up and move it somewhere else. When I walk out the door, my self-worth may or may not walk with me. When it walks with you, it's because you have a plan. When it leaves behind and you're floating around out there trying to anchor your self-worth to something, it's because you didn't.
If you were to craft, the perfect relationship, and this is, not the deal team, and so on, but if you had a human support team, that looked like, and do you think that exists today in any great measure?
So the perfect advisory team, in addition to all the technical people that we've been talking about, who are absolutely necessary, would include what I call a counselor with genuine expertise working with the business owner facing a major life transition like this, facing this level of change. I don't think they're a therapist necessarily in the traditional sense of the word. I think they're someone who understands the specific identity and purpose disruption that comes with exiting a business you've built over potentially decades. So I see their role as kind of an emotional co-pilot, if you will, for the owner throughout the entire process, not a referral, when things have ended, like the transaction is done, and then things are already hard, so to speak, and then you go talk to this person. I think they're on the team from day one, really setting the owner up for emotional success. It's really someone whose only job is to help the owner navigate the human side of what's happening in real time, right? So to your question, that role does not formally exist today. I know some people who are working on that side of the mall and trying to create some systems around it, and they come from various backgrounds. There's no credential for it. There's no established referral pathway. There's no standard place in the deal structure for it. It's a genuine market gap. And I think, it may be the most important work, honestly, that still needs to happen in the field.
There's some of the financial advisors, attorneys, and CPAs and brokers that are listening to this episode, and you teach a lot of those folks. What one thing they need to change about how they work with a founder approaching exit? If you didn't have to sugarcoat it, what would you tell them?
Oh boy. Well, this is going to be a hard thing for transactional folks to hear, but jettison transactional thinking. Get rid of it. Embrace transformation, right? So, and get really good at embracing it, by the way. Don't just do it kind of like, oh, I guess I have to embrace transformation today. No, get really good. Understand it. So the demand for transformational processes is already there. Right? Owners know they need more than transactional results from this process. Research shows that 81% of business owners who recently sold wish they had spent more time preparing for the sale. That comes right from UBS, by the way, UBS Investor Watch in 2023. That's a market signal for all of us right there. There's 81% of the folks out there who wish they'd done more planning. So they're telling us what they want, and they're also telling us what they're not getting as they go through it. So I think the advisors who build the capacity to meet owners at a human level, where they are as a human, not just a technical one, we can all do that pretty well, will be the ones, those folks who can meet the owners at that human level. They're going to be the ones who define what this profession looks like in the next decade. I will have already laid down my sword by then, right? So I genuinely hope it will happen because it's absolutely necessary.
For looking out over the next 10 years or so, with the boomer exits are going to come one way or another. Do you think that the current generation of advisors, whether they're CEPAs or others, are prepared? Or do you think they're going to be caught flat-footed?
Well, I certainly think we're more ready than we were 10 years ago. Had it happened, say, in 2008 through 2013, like folks thought it was going to happen originally, I don't think we would have been able to handle it at all. But I think when you're talking about baby boomers or just generally ownership transition, no matter what generation is doing it, it's pretty difficult in the United States to fully understand the scale of that, right? So baby boomers right now, roughly, they used to own maybe 70 or 75% of the operating concerns in this country, in the USA. Now only about 41%. They've been supplanted. Their majority has been supplanted by the combination of Gen X, mostly Gen X, and then millennials. But the baby boomers still own 12 million businesses in this country, and they employ 25 million people, right? Gee. Because their businesses have been around longer, they're generally weighted more heavily in the total value that's changing hands, which is in the trillions of dollars. I would say just in baby boomers alone, we're probably in the $10 trillion neighborhood, maybe higher. So there's a lot at stake. What's interesting to me, I don't think it's just about boomers transitioning out of their businesses, because Gen X and millennials are a big part of the mix now. It's the entire ownership ecosystem in the United States that's being reshaped at the same time. So when this many businesses, 12 million businesses, are staring some type of transition in the face over the next 5 years, say, that's what owners report they want to do when they're surveyed. You can imagine the restructuring of the economy that's going to take place as a result of that. So a lot is going to be in motion. Now, I'm not sure that the challenge is entirely just the volume of transactions that may take place or equity transitions. I think it's compression to a certain extent, time compression, right? So as I mentioned, we've been talking about this wave for years, and now all of a sudden it's got to go, right? There's just, it can't stay, there can't be so much pent up in the pipeline anymore. It's got to go through. Time, father time always wins. It's gonna go. So I don't think the industry is there. I don't think our capacity is there to scale thoughtfully around that to a certain extent. I think we just don't have enough people, or our systems are not scalable enough to handle such a large volume, which means a lot of people are going to be left behind, by the way. I mean, there is going to be some carnage, no question. So that thoughtful scaling in a compressed time is really the test, right, of whether this is going to go well. Now, I will say this. AI is going to change the conversation significantly. Already is. I'm seeing it reshape how advisors do research, assess readiness, and scale capacity. I'm an optimist when it comes to AI. I believe it's absolutely going to lead to some great places, but I also understand, talk about change management. I also understand that it's going to completely rewrite like the hard drive of how we are used to doing business and will do business in the future. But as an advisor, it makes my work far more scalable than it was even a year ago. And I think that's going to matter.
You and I have been, I don't even know how long ago I met you, but you've been doing this for 3 decades plus, and you help folks get ready for what's ready for next. Where did it come from? Came from
That's
there.
right.
And you and I have talked about, there's more to do than you have. There's not enough of you to go around. How hard is it for you to step away from serving everybody else and serving yourself? Like the proverbial thing about the cobbler's kids running around with holes in their shoes. How hard is it for you to step back and work on your needs and your exit?
Well, I don't have any kids, but it's definitely the case that the cobbler is making his own shoes and sometimes walking around with holes in them. No question. If I'm the cobbler, I do go barefoot, hopefully on the beach sometimes. But seriously, this work is constant on my side, right? So I'm 59. I've set a goal to retire at no older than 70. I would like it to be earlier. My personal financial planning is in good shape. I have a real plan, what I consider to be a real plan for for what comes after I exit my businesses. There are some assumptions. My health holds up, family caregiving goes as planned. I mean, there are so many factors. You'd like to believe that you just get that kind of clean break and now you're going to do what it was that you planned, but there are so many different versions of it, and you need scenarios in order to manage this, right? So I think about it a lot. The hardest part, because of the business that we're in, the hardest part for me that I'm still really working on is figuring out a way to scale this business effectively to the point where it's completely independent of me. Right. And that's a tough one. Owner dependency is, in fact, the thing that we help our clients solve for, right? That's at the core of our business, is helping our clients have a business that's less dependent on the owner or the founder or key people, right? And manage that knowledge that I was talking about, that knowledge transfer. But it's also the thing that I really have to solve for myself at the end of the day. And we're starting to do that. It's a work in process, but I'm honest about it. I know what we're up against.
It's a funny thing. We have our favorite breakfast place up in Castle Rock.
Yeah.
And I think about today's conversation, and so much of this conversation we've had one way or another many different times. That's in true. The past. And you have owner dependency issues. I have owner dependency issues. You're a former business owner. I am too. And you look at the challenges of trying to serve the folks that you need and trying to serve your family at the same time. And there's answers. But you don't get there by hoping to get there. System, discipline, process to execute to get there is certainly one of the things. But I really appreciate you taking the time for us to take in and actually get this on the record, and so I hope, that it helps others that are listening, to take in and take steps and, get organized and get busy. So, with that being said, Sean, thanks again for your time.
Thank you, Bob.
This is the Exit Series. I'm Bob Rourke, and if you know of a founder who's sold, a broker who's seen it, or an attorney who's been across that table, send them this episode, subscribe wherever you listen, and see you next time. Sean, thanks again.
Take care.